So now that we've covered the U.S. and just what's happening internally, now it's time to turn external and see what's happening. What are the changes that we're noticing? And we'd like to remind you, please like, share, subscribe. Your content, your comments, your support, greatly appreciated. So when we look at what's happening in the market today, we see that there is exports were down in the U.S. for coming out of the U.S. in gasoline by about 285,000 barrels. We thought there was going to be, again, that drop along that 5-year average, that 9-year average. It was a little bit bigger than what we were expecting, but again, nothing too crazy in terms of that overshoot. Distillate was the one that we thought was going to have that kind of outsized down move. That's something that we're going to see, again, that kind of bounce back, but it's still going to, distillate's going to continue to disappoint. That was down 518,000 barrels. The one that I can't stress this enough, LPG is the one that we remain the most positive on. Demand in India. So demand is actually shifted now, where diesel is number one in terms of product demanded. And it's now crossed over where propane is number two. So it is now displaced gasoline as the number two product demanded in India. And again, I just use them as an example. That's the increase that we continue to see on the LPG side. That will be supportive for our exports, just given pricing, issues in terms of just canals and getting things into the system. So again, those are things that are going to be beneficiary. Crude exports down 621,000 barrels. That not as much as we were expecting. We were expecting to come closer to about 2.8. Instead, we were at about 3 million barrels a day. We, again, just given what we're seeing in the market, it's going to be between that 2.8 and 3 million. Again, this is going to be those timing moves in terms of when do we kind of get that snapback. We did see some slowdowns in purchases, which is going to weigh on just, again, getting back to that 3.6 level. And again, there was a big push to get stuff out by year end. So now that we're starting to get into this level, we do have an increase in buyers, and we have seen buying remain fairly robust out of South Korea, China, and India, as we talked about. Not India, I'm sorry, in Japan, as we talked about in the Frac Spread show on Friday. And that's going to be something to watch overall. Inventories, again, remain, this is global oil inventories, remain over 160 million barrels above the 5-year average. That's what OPEC is looking at when they talk about cutting and trying to bring some of that down. The issue remains is there's still that spare capacity sitting out there that at any point in time you could see kind of that snapback, especially on the export side. Saudi Arabia reduced crude oil supply to about 11 refiners in Asia and Europe, following that cut that were talked about in February and March. So while that is a positive, we did see them fill their requirements to about 2 refiners. So some got the additional, others didn't. The bigger problem that we're continuing to see is some builds in West Africa, which again we'll talk about in later on. So when we look at gasoline exports, we were thinking that we were going to come back down but remain above that 9-year average. Instead, we fell just below that 9-year average. Now that we continue to see issues on an economic level, COVID cases aren't as bad in parts of Latin America where some of this product is going. So there is support for our exports over the next few weeks. It's not going to be at the levels that we kicked off the year at. It's going to be above the 9-year average, but not back to the top of that range, but it'll be some support for some of the elevated storage that we have. The bigger issue is, gasoline coming out of Europe, that has slowed down a bit, but we're not taking as much into the U.S., which is going to move into other parts of LATAM, the Caribbean, which again will be headwinds for our exports and keep us fairly capped. So we thought that distillate exports was going to fall to the bottom of the cloud. Instead, it kind of blew through it and ended up at the setting that new seasonally adjusted low going back over the last 9 years. Again, we're going to get that snapback, but we actually think it'll just fall back within the bottom of that cloud overall, just because, again, we still have a lot of distillate coming out of Europe Now it's less than it was in December, but it's still elevated, and that's going to keep some of our exports capped to the point. And then we also have less imports going into Europe, which is where a lot of our products go, because if they're exporting more distillate than normal, and that means they're not importing, and if they're not importing, it's not coming from us. So that means that we have to go out and compete in other markets. Those other markets are typically fed by Asian and Middle Eastern barrels. That's going to be that competition that we continue to see, which will keep our exports fairly capped at that at the bottom of that cloud overall. Now, crude oil exports, we fell back below 2019 levels, but again, we're still elevated. We have more facilities available. There's more demand, especially as we have Saudi cutting grades. People are going to start buying now, take delivery in February. Again, these are things that are going to continue to move. We will have kind of capped at the top of the range, but again, that 2.8 to 3 million is a very comfortable number, especially as we have Alaskan grades continuing to move into Asia. The issue is going to be, what is Europe demanding? Because Europe remains capped. And then what is Asia demanding, which is capped but remains strong. So again, that's going to be that support, because right now we have about 2 million barrels a day. That's just essentially that captive from Asia and Europe. Then the delta is going to be, what is that 800 to 1 million barrels additional going into, or spot cargoes, or just some one-offs that will keep us elevated in general. Propane, new seasonally adjusted all-time high going back 5 years. We could go back as many. This is going to be the high. Again, as we were saying, we were going to trend above that, or at least at the top of the cloud. You can see that we're following kind of where we were end of January. It's just the trend is going to continue to be at that new all-time high. We'll continue to set records depending on if we fall within some of these spikes. Then it's the average is going to remain strong, not only because again, just in international demand remains very strong. The U.S. has that spare capacity, and we do have more facilities and more capacity now than we have ever before, which is going to be supportive of our exports in general, and just in terms of removing some of those bottlenecks. And this is just an example of some of those bottlenecks going away as we see the terminals increasing throughput. You can see that we're getting it from Mariner South. Obviously we have the Phillips facility in Freeport. We continue to see Enterprise remaining very strong. This is just giving you that idea, that kind of idea of how we're going to continue to see that surge. There will be not so much seasonality, but there will be bottlenecks. There's always timing delays coming in and out of Houston. Again, you can see that's the kind of natural ebb and flow. But again, this is going to be a very strong number as we continue to move into the remainder of the year. When we look at OPEC December numbers versus November, this is just looking at December compliance. You can see that there are some people that are falling out of compliance. Nigeria was at 119%. Again, that makeup number into December, which is starting to reverse as we head into February. Again, not above the new adjustments, but just giving you an idea of where things sit. So total compliance, the UAE one is going to be one to watch, because that's the compliance that we think is going to adjust. For the OPEC 10, 101% compliant, so right on the nose. The bigger issue is obviously Libya. Libya is pushing higher. Again, their change was 150,000 barrels a day from November into December. December into January continues to be strong. We continue to see investment in some damaged pipes, in some damaged fields. Right now, their production's at about 1.3, 1.28, 1.3. That will continue to pull some of these exports higher, and averaging about, let's call it about 1.2 is very doable. So just above 1.2 or maybe 1.22 is very doable as we go into the end of January and well into February and March. The bigger issue is going to be non-OPEC. This is where we continue to see a lot of that slippage in terms of who is compliant, who's not. Obviously, Russia missed their compliance by about 5%, which again isn't all that surprising. Russia hasn't been very good at being in that compliance. This is where we continue to see some of those issues. Kazakhstan, same thing. And this is It looks like they took the numbers that were expected in January and just did them in December. So now in January they'll be compliant, but it'll be at elevated levels. This is also some of that bullishness that we saw in the market where everyone's saying, well, we've seen the market already essentially absorb and maintain some of the barrels that were in December, and we still had draws. So now that it's coming in January, it's already expected, not a huge deal. But how are we recognizing it? So when we look at crude oil in transit, we're trending just above that 5-year average. But again, it's going to be kind of this ebb and flow. You can see that it normally kind of trends down at this point. We just think that the 2021 so far is going to remain elevated. It's going to be above the 5-year average. But again, it won't be at the top of the cloud. It's just going to be above where we see that 5-year component overall. So these are things to consider as we go into the general flow of things. Now, as we look at crude oil on the water, as we talk about oil in transit trending above the 5-year average, now this is why we think crude oil on the water is going to trend at the top of the cloud, because we still have an elevated amount of crude sitting offshore. When now we have an increase in crude oil in transit, that's going to put more crude oil on the water. So we're going to trend at the top of the cloud as we go through the next few weeks. And again, when we look at crude oil and floating storage, you can see again kind of trending at the right at the top of the level. That number right there, that is the spike, that's 2017, which if you think about, 16 and then 17 had that floating storage, as we had an very large amount sitting in off the coast of the Middle East. That is why, but again, we're still trending well above average for this time of the year, as we normally see crude from floating storage coming on shore, especially because this is usually when we see those increases in runs as we go into core demand season for heating oil and diesel for, again, those heating purposes. That is we're just not seeing the same type of demand numbers. Now, when we look at total tank stocks in Europe, news, going over the last 6 years or so, you can see that we're setting a new high. We're now at the, essentially outpacing where we normally are. We typically see a drawdown. Instead, we're seeing a build. And this is just what we're seeing in Europe is giving us confidence that we're going to continue to see these numbers sitting just at the top of the level overall. But there's really nothing telling us in Europe, again, coming back to lockdowns, coming back to issues, how we continue to see these problems continuing through the remainder of January. Now, when we look at what is happening overall, here you can see kind of where exports sit and loading schedules. So even though Nigeria was able to meet production numbers, they still outpaced December numbers in December, with sitting at about 1.6 million barrels, 1.58 million barrels a day going into the water. That pairs down in January, but we see an increase in Nigeria in Feb, and that's some of the slippage out of Jan as we see some price cuts that have been kind of rolled through, which we'll talk about in a minute. Russia continues to trend higher. You can see December into January, those increases in loadings. Again, the biggest one is going to be Libya. Libya continues to trend higher, adding anywhere from 50 to 100,000 barrels. We think that we're going to get another, let's call it 50 to 75,000 barrels a day from January into February, as we do have an increased loadings in Sirte and some other areas, which is again going to weigh on just what's going into Europe. Norway is at 1.72. Again, not much change from where we last spoke, and it's just we're back to highs that we haven't seen since essentially 2010. Brent time spreads started to come off a bit. We had that spike after the news. This is looking at March to April, so we're just looking at some of that near-term time spread. Depending on the time spread we look at, some of it is a bit more bullish, some of it's a bit more bearish. This one is a bit more bearish on the near term, just as we have the numbers coming off, and it makes sense if you start to think about some of the spot cargoes. We have Senegal again cutting prices again for a third time. Last time we spoke, it was 2 times. Now they cut it again over the weekend, going into the beginning of this week. So that, again, that's putting some of that downward pressure. We're still in the backwardation mode with zero, crossing over from zero down. That is the contango side. So again, you're starting to see some of that pressure coming back in. Now, when we talk about margin, here we see Singapore, some of the blends going negative. We're just hovering just above zero. Again, this is going to weigh on just activity we can't do as much. That's going to weigh on just how do we see demand growing? And this is, again, going to weigh on that total demand number, because not only do we have margins down, but we also have an elevated amount of product in storage. So this is just kind of pulling out. We're taking the Dubai hydrocracking refinery margin, and you can see that we're sucking around that zero. So that just means that they're not making any money. But when you factor in storage and all the others, it's actually negative. So you can see that we have had worse, but over the last 5 years, we continue to see a problem in terms of just activity in general. Shifting to Fujairah. So Fujairah reported 22.2 million barrels in storage. It's the first time that we're below 23 million since the end of November. That's a positive. It's just, where do we see things going forward? Total stocks fell 1.25 million, and we have to look at, okay, well, what really drove that? So light distillate, which is that gasoline naphtha, was up about 60 basis points, 42,000 barrels. That continues to grow. It's the fifth consecutive week that they've held above 7 million barrels. Less demand on gasoline, that less demand going into Asia. That is a point of concern when we consider about the consumer. Where is that flow going? And again, the consumer continues to be the underlying problem. Middle distillate, the one that we've been talking about the most, that fell 70,000 barrels to 4.4 million, which is down 1.6%. Again, the gas oil market remains a problem. We had some steady flows from the Middle East and India continuing to Asia. So we are seeing some flow from the Middle East and India into Asia. The bigger issue is going to be, what is China doing? What are the lockdowns causing? And the slow movement of product continues to be an issue. So really, the draw was driven by heavy resid. Drew by about 1.2 million barrels, which is down 10.5% to 10.84 million. And this is the first time that we've dropped below 11 million since early December. And the bunker activity picked up, not because we saw a big increase in shipping, but there were fears on the rally and flat pricing. So guys try to lock in pricing, try to lock in some of these movements. So again, this was more of a financial transaction. Now, given it still moved it from storage, but it's from one storage to another, and it was less about actually moving into the market and getting rid of some of that demand. Instead, they filled the demand maybe ahead of where they needed it, which again will put more back into storage, especially as we have refiners continuing to operate at elevated levels in the Middle East for the most part, which is going to put it into storage in general. As we look at crude oil and floating storage, we're 51% higher than a year ago. So again, we're still over where we were in 2019. The amount of crude held in storage, which is stationary for that 7 days, rose to 93.8 million barrels. Again, that's up only 10 basis points from where we were to start out the year, which was at 92.98. Again, kind of that margin of error, essentially. Asia Pacific saw a 2.1% increase up to 62.5 million. That's the point of concern as we start talking about South Korea, which has actually reduced refinery runs again. There was an expectation that they were going to increase runs to about 85%. Instead, they're going to maintain them at about 80% with a likelihood cut to about 78%. West Africa is up 82%. Again, small number over small number gives you a big percentage. But overall, that's an increase by 6.6 million. That goes to 6.6 million, which is the highest since July. Again, coming back to why Angola is starting to cut, why Angola and Nigeria have cut their loading schedules, just because, again, there's a lot of crude floating offshore. Europe was up 10%, Middle East was up 56%, North Sea down 29%, Gulf Coast up 16%, but we have to kind of consider, what does that mean? Crude supertanker, crude imports, we held at 102. So you can see that we're still above the seasonally adjusted high going over the last 5 years. But we haven't seen much change of where we closed the 2020 and at where we're starting 2021. We're still seeing the same amount of flow, again, which is going to put more crude in floating storage in the near term. And this is where we see, obviously, Asian floating storage. Asian floating storage, seasonally adjusted all-time high. Clearly, we're not where we were as we headed into 2020, but we still remain well over where we have been in previous years, and the trend continues to angle higher. That will continue. Again, Japan has their lockdown, slowing imports. Australia is just not seeing the same type of pull-through on less consumer demand. South Korea reducing runs. India is fairly flat in terms of where we are, so we'll see some additional. The bigger issue is going to be China, where we see some additional ships piling up on the coast. North Sea down again, as kind of we thought it was going to be fairly flat. Instead, it moved closer to the 5-year average. We did have, as we've been saying, and we covered it a bit on Friday, some new cargoes went from storage and is now in transit and is heading to Asia. Again, we picked that up in our oil in transit number. So it just transitioned from floating storage into transit. It's not anywhere. It's currently in the water and heading to a new home. So here you can see we're outpacing, setting that new 5-year seasonally adjusted high. Sangola cut prices for February, loading crude for the loading crude for the third time this month. So again, these price cuts into February is concerning, just because we did get some price increases out of the Middle East, and we're seeing some price cuts in February loading. Nigeria plans to raise exports, and again, right now they're increasing some exports. But the commentary is that they're raising condensate exports, not oil exports. Yeah, that's up for interpretation. But again, these are things to consider when we're looking at what is entering the market. Middle East crude floating storage. We just wanted to show in terms of where we were in 2016, 2017. Obviously, that was when we had that breakdown of the OPEC deal. But when we normalize it and look at where we had that fairly intact, you can see that we're still trending up. And just given what we're seeing out of the UAE, what we're seeing out of Iraq, we're going to continue to see some of these builds in floating storage, which again was part of the impetus as on why Saudi cut. The issue, or what we're going to continue to watch, is they've talked about cutting production, but where are exports? Because that is going to be very important to appreciate it. And if they're cutting both oil production, oil exports, are they increasing refined product exports to try to get, try to maintain some market share? Again, a lot of levers to pull to show something, but then not actually realize it. But net, it's still a positive that they took the 1 million barrels off the market heading into February. You can see here, as we said, in Europe, we expected to trend along the 5-year average, and here we are. Not too much is going to change here. We think we're just going to hold at this level. Now, as we start to look at where some of the demand numbers are in general, one of the things that we forgot to mention was the decrease in European total storage. So we did get some reductions in Europe. When we look back a month, we saw crude decline by about 3 million. We did see some reductions pretty much across the board as we looked at product in general. So now that we kind of starting off the new year, you can see where we sit in terms of just what is in storage right now. On a gasoline inventories, we sit at essentially the top of the range. The only time it's been higher was essentially during downturns. So this remains something that we think is going to trend higher, but we continue to see exports obviously reducing, but still elevated. So that's going to kind of keep this flat, as we do have some refiners starting to turn back on within Europe. In general, gas oil continues to see builds. That's going to be one to watch. And obviously gasoline, these are ones that are going to be a bigger issue going forward. Gas oil is still elevated above that 15 years or so average, but again, we think it's just going to trend in a very similar direction, as we do have distillate imports remaining low. We continue to see distillate exports remaining elevated, and that's how they're trying to manage some of this elevated storage. International, looking at Singapore. So Singapore starting out the year, new seasonally adjusted all-time highs on just all oil stock products. Again, this is that concern that we look at in terms of Asia, which is why we think we're going to see more crude sitting in floating storage as we have just this elevated amount of product sitting in the market. Middle distillate, the only time it was actually higher was 2017. So again, we're sitting at these elevated levels, and it's just based on what we're seeing in the market. It's not going to increase, but we don't see it decreasing. It's just going to go flat and continue to remain elevated, especially as, again, when we look at Singapore, Singapore cracks on the refining side remain very weak. Light distillate, same thing. We're sitting there at very elevated levels. And just based on where we're seeing light distillates as Fujairah, as we start to look at other areas, this is going to remain a problem as just gasoline purchases and other light product purchases remain weak. State-owned, and this is just looking at China. So China kind of closed out the year at this average of about 76%. It's very low for where it is this time of year. And it's just they had to make room for not only teapots, but also for new refiners. And we expect to see some of these run rates start to increase, while at the teapot side, they're holding strong at 75%. I would have said that they would have started to see some declines, but they continue to see an elevated level of demand at about that 75% level. And here you can see, kicking off storage, we declined about 2 million barrels, but again, we're at 42.5, so we're still well over where we normally are on the 5-year average, pushing to those to the upper levels on the teapot and the Shandong refiners. And this is when we look at fuel oil. Fuel oil is setting that new record, but again, it's just remaining elevated as we do have some slowdowns within China now that we have some cases, which is causing them to lock people back in their homes, as we do have asymptomatic and symptomatic increases, which, as we know how they respond, it's going to keep activity fairly low. And then as we go through the energy, the econ show, we're going to talk more about India, China, Asia in general, and we'll look at kind of where things sit on a go-forward level. So that's it for now. If you have any questions, if you want us to expand on anything, please let us know. We love feedback. And again, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.